When hearing money supply, it's easy to picture a single massive vault of cash. But in reality, that monolithic pool of wealth shatters into millions of different financial instruments. Modern capital exists across a vast spectrum. It appears as physical coins, digital checking accounts, locked savings accounts, and long-term funds. To make sense of this chaos, economists sort all of these different forms of capital using a single metric: liquidity. Liquidity measures the amount of friction and the time required to convert any financial asset into immediately spendable cash. To accurately track the economic health of a nation, central banks divide the total money supply into a nested hierarchy of 5 aggregates, labeled M0 through M4. By constructing this 5-tier model from the ground up, we can see exactly what central banks are measuring when they evaluate the economy's vital signs. We start at the absolute bedrock of the monetary hierarchy, M0, often called base money. The first component of M0 is every physical coin and paper bill currently in circulation among the public. The second component is bank reserves. These are the actual physical pellets of cash held securely inside the vaults of commercial banks. Notice what is missing here. M0 strictly excludes the digital balances sitting in your checking account. M0 represents the absolute baseline of liquidity. It is pure cash with zero conversion friction, but makes up only a tiny fraction of total wealth. To capture the digital capital that powers daily transactions, we expand our diagram to the next layer, M1. Mathematically, M1 encompasses all the physical cash of M0, plus the addition of what banks call demand deposits. Demand deposits are exactly what they sound like: bank accounts that give you immediate access to your money. If you can swipe a debit card at a grocery store or pull cash out of an ATM, that capital is available on demand. Because M1 represents the highest volume of capital available with virtually zero friction, it serves as the primary fuel for daily consumer spending. Moving outward again, we introduce the M2 tier. Notice this layer is slightly frosted. This represents the introduction of liquidity friction. M2 includes the entirety of M1, plus a category of assets collectively known as near money. The first major piece of near money is your standard savings account. Unlike checking, it usually requires a transfer step before you can spend those funds. The second component is small time deposits. These are deposits under $100,000 locked into a bank for a specific time frame to earn interest. Certificates of deposit, or CDs, function the exact same way. With M2 capital, you sacrifice immediate access for a guaranteed yield. It's highly relevant to overall wealth, but structurally slower to mobilize than M1. Finally, we reach the rigid outer bounds of the money supply, M3 and M4. M3 swallows up all of M2 and adds money market funds, mutual funds, and ETFs. At this stage, conversion friction jumps significantly. M4 is the final aggregate. It contains all of M3, plus the least liquid financial assets that reside entirely outside of the commercial banking system. These outer tiers hold vast, multi-trillion-dollar stores of wealth, but because of extreme conversion friction, they cannot quickly stimulate immediate economic activity. That theoretical 5-tier model covers everything, but in practical operation, central banks focus on what actually moves the needle month to month. For precise macroeconomic tracking, central banks actively disregard the high-friction outer bounds of the money supply. When a central bank publishes its monthly money supply reports, the data dashboard almost exclusively tracks M1 and M2. The assets in M3 and M4 carry too much friction to serve as reliable real-time indicators of sudden economic momentum or rising inflation pressure. Whenever you hear financial analysts, policymakers, or the news discussing the money supply, they are not talking about all capital. They are strictly analyzing the highly liquid, low-friction aggregates of M1 and M2, the actual fuel driving the living economy.